Good morning. It is Monday and the stock market is closed. What's going on? Well, it is a holiday in the United States and we will not trade today, but trading will resume tomorrow. So hang tight, do your homework, and get ready for tomorrow. In this live stream, we're going to do a little bit of homework. We're going to review some stocks that members have messaged me and asked me to review. Glad to do that and cover a couple of key stocks that were sent to me. And we're going to go over what's going on with the markets. Most of you are returning participants, guests, and you know what I'm about. I'm about fundamental analysis, looking at companies and trying to understand what is their value based on the free cash flows that company is going to produce in the future, as well as the profitability of that company. Checking in on the balance sheet, making sure that they have a good balance sheet. Sometimes stocks look really good, but they carry a lot of debt. And there is such a thing as debt spoiling good companies. If good companies have to pay a lot of interest, it just takes away from their ability to grow, takes away from their ability to compete against their competition. Just a lot of things get taken away. So we want to make sure that balance sheet is good. Overall, this year has been a good year. First couple weeks of trading, stock market's doing well. The S&P is up 1.38%. The Dow is up 2.7%. The Russell up 7.89. Go Russell. And the NASDAQ's up 1.18%. Cody, I've got CarMax on the list. Good to see you. Thanks for sending me that message. I got CarMax on the list. And I thought we could do a CarMax versus Carvana. Kind of a little cage match there to see which company looks like a better investment. Thanks so much for being a member. Hang tight. We will handle CarMax. Thanks. All right. So year to date, the indexes are higher. Now, tomorrow morning, we're supposed to open lower. Let me see if things have changed. I don't think they have. Futures. Yeah, we're heading a little lower. Well, what's going on? Well, President Trump has put out there that he's going to start charging a 25% tariff on countries, I guess, associated with Greenland or with Europe, or I don't know what the details are, but high level, it's a bad thing because it's just another tariff, and tariffs are not ideal, right? I'm a free markets kind of guy. I believe capitalism creates value for everyone, whether you're an employee working at a good company or you want to start a company or you want to invest. Capitalism rewards those that work hard, take risks, create value for their community, for their economies. Tariffs are a tax, in my opinion. And taxes, we got to be careful. I live in California, so I could tell you that I like a lot of things about California. In fact, I love a lot of things about California. But one of the things that is a little frustrating is the level of taxes. I think that the government can do a little better at getting better with the money we send them. So overall, the tariffs are a bad thing, in my opinion, and they are causing some bad vibes to go through the market in the futures at this point. Now, how long these tariffs are going to be out there for, I can't tell you. It could be a week. It could be a month. I don't know that they're going to last a whole long time, because I think the last time we had the tariff scare, Liberation Day in 2025, it got ugly. It got ugly real fast. And the government decided to pump the brakes. They were like, wait a second. Yeah, we don't want to take the stock market down to a very, very risky level. And what also happened was I think the bond market began to collapse. And that could have been a real ugly mess. So, lesson learned for all participants, right? First, we know the government is going to observe the market, make sure that they're not creating a real bad environment for the stock market or the bond market as well. And I think this could be just a little bit of tension, and tension and provocative behavior is not something new. We've seen it for some time here. So let's just see how this thing plays out. But we may see some sell-offs tomorrow. The NASDAQ is probably doing the worst. It's down 1.52 in the pre-market. Gold is going up. I think people are fleeing over to that gold, away from equities. So that's what's going on. No big deal. Over the last couple of years, we have been doing great. So we just had some adversity. Every year, I recorded a video for super investors on my channel and released it. And, one of the comments that I put in there is every single year for the last 5 years, going on 6, we have a substantial sell-off correction. Last year, we had it right in April. It was a doozy. It went down fast, and we took advantage of it. We bought some terrific businesses at a really good price. And in 2024, we had some scares. We had some sell-offs. Just look at the charts. Let's look at them together. So here's the 5-year. So, of course, Liberation Day was a doozy. Stock market went down 17% in a matter of weeks. That one hurt. Now, 24 was so darn smooth, huh? Smooth operating stock market. We still had pullbacks along the way. And some markets, some industries pulled back harder than others. In 2023, that was a really good year. And that year we had a substantial sell-off, toward the end of the year where we had stocks sell off. And of course, in 2022, I don't need to convince anybody, we had a very good stock market correction of 25% on the S&P. And going back to the COVID years, at the beginning of 2020, we had a big sell-off because we had that big pandemic. And that time was pretty scary, mostly because, the pandemic was, a lot of people were dying. The stock market was there. I didn't sell any of my stocks. I actually put more money in and kind of got ready to see what was going to happen next. So in 2026, we will see adversity. It's stocks. We have volatility in stocks, but overall, you want to be invested. You want to take your wealth from here to here. Over the span of 23 years, investors would have done great, multiplying their money times 7 that they invested at the beginning. And over time, you keep putting money in. If you're an earner, you really build your wealth and you build skill sets, knowledge, so that when you wake up in 2026, you're capable of making really good investments. You really have a good sense of where your strengths are as an investor and where you can make the most amount of money and continue to grow your wealth. So overall, I think we will see adversity, but no big deal. We've seen it before. Okay, so we have some earnings coming up this week. What I'm going to do is I'm going to save a little earnings talk for later in the stream. But right now, we got to look at CarMax. Getting my car retailers mixed up here. All right, CarMax is a company that is a used car, I'm going to call it retailer, dealership. It's nationwide. It's a pretty neat thing. I actually bought a new car in 2020 at the end of 2024, was it? Yeah, end of 2024. Bought my wife really nice car, and I took one of our vehicles and went and sold it to CarMax. Really good, smooth process. It was a good car. We were the original owner. Low miles. Sold it to them. They gave me a check. We were good to go. So I've used them on occasion. I think I've sold them cars, but I've never bought cars. I usually buy new cars. I don't want to fiddle with used cars anymore. So I know what they do. These guys, when we had the used car price surges, I'm sure these guys were just rolling in cash. I'm surprised that they didn't do better, but I guess it was back here that they were doing really well. Let's take a look at comparing CarMax versus Carvana on the charts, because I know Carvana is really screamed up. Maybe you're thinking that might be what you want to do is if CarMax, yeah, so here's the 1 day. We don't want to see the 1 day. So here's the 5 year. So Carvana has really just taken off. And I do have a valuation art, I think, on Carvana. I've looked at it so I can speak to it. And I think it's way overpriced. We'll get into it. And maybe CarMax could, if anything, just go halfway up toward Carvana. It could be a nice winner. Okay, so what are the things we're looking for in a stock? A couple of things just to put it out there, since this is the first stock we're going to do on the stream, is we want to see revenue growth showing that this business is strong. More customers are coming. They like doing business with CarMax. So we want to see top line revenue growth. It signifies they have pricing power. They can raise their prices, increase revenue. They have that type of loyalty, or their product or their service is that good. We also want to see profitability, the ability to generate profits. We'll look at the gross margin, which is the top line, total gross margin. We'll look at the net profit margin. We're also going to look at the net free cash flow margin, see what kind of cash flow they generate. And we're going to take a look at the balance sheet to make sure we don't have excessive debt. Measuring the balance sheet, the simple ratio is debt to EBITDA. EBITDA is the earnings before interest, taxes, depreciation, and amortization. What that, in essence, just simplified, is if a business had to dedicate to just paying off debt, that would be the line that you would use so that that business could pay off the debt. Okay, so now that we've got that sorted out, let's take a look at CarMax. So CarMax is a $6.92 billion market cap company. Revenue is way above that number. Forward P at 21. It was at 16. Analysts think it's too expensive. Over the 1 year, this is really sold off. Okay. Taking a look at their performance, top line. Let's look at the top line. Here's the revenue. It grew a tiny bit in the trailing 12 months. Let's zoom in on the quarterly. The most recent quarter, the company had its revenue go down by 6.66%. Looking at the previous quarter, the revenue went down by 5.26%. They did have 3 quarters in a row of growth, but when we look at the trailing 12 months, we have a contraction with the 2 most recent quarters showing weakness. So that tells me they're just not selling enough cars. Maybe car prices are going down. Therefore, CarMax can't make the kind of revenue that they were making before. So they have $27.8 billion of revenue, only $3.4 billion of gross profit. So I'm not going to like the gross profit line, I could tell you now. So 12.39%. That's not very good. In the kind of the scheme of profitability, you have some businesses that are making 90% gross margin. They have just these really valuable businesses, and this one's not one of them. They're distributing, retailing used cars. That business has been around for more than 100 years. It's not an exaggeration. I'm not using an analogy there. The car business has been around for more than 100 years. The retail business has been around for more than 100 years. So the level of competition, the alternatives customers have, you can buy private party, you can buy a new car, you can lease a new car. So there's just constant demand, constant competition from many different sources. So that leaves a very little room for error. Their operating margin is 2.6, and then their profit margin is 1.65. Not very profitable, and the stock has not really done well. And you see that back in 2020, 2021, 2022, when their profit margins were better, that's when the stock was working. But right now, their profit margins are pretty low. So that's pretty low. Free cash flow has improved, 7% on the free cash flow margin. That looks good. That's an item of positivity there. So far, revenue is slow, sluggish, contracting in the last 2 quarters. Profit is hard to come by in this business. They're not alone. You'll see in Carvana's case, it's similar. All right, so let's take a look at the balance sheet. So they have total debt of 18 billion, cash of 205 million. So they have $17.8 billion of debt. Look at this debt to EBITDA number, 13.5. That's my limit is 3. If you go above 3, like between 3 and 4, maybe it's excusable for certain reasons, but 13.5 is like, do not touch. It's like a hot stove. It's got little signs all over it. This stove is really hot. Do not touch it. You're going to get burned. That's the sign I would put myself on a debt to EBITDA of 13.5. Do not touch this stock. If you have and they have had a slowdown over the last 2 quarters, but if you have a drastic slowdown, let's say recession, just other big issues cause CarMax to slow down, this is a bankruptcy risk. Okay. And if they were to go down that path, talk about a sell-off, we would have a mess on our hands. So this one here is not looking good. Not looking good. Based on what I like to invest in, as mentioned at the beginning of this stream, this one is not fitting the mold that I like to follow, the recipe for success. Analysts think it's priced too high. Even though it's sold off, they think it's still 17% too high. Now, things are supposed to turn around. We are in the year that will end February 28th, 2026. And as mentioned, last 2 quarters show it's a contracting year. Sales are going down. Look at here. Sales went down, sales went down, sales went down, sales went down. So we're not dealing with a company that's on a winning streak. It's the opposite. These guys are on a little bit of a losing streak. Now, going forward, they may turn things around. It's still a super risky stock with that balance sheet because they're not going to pay that debt off anytime soon. And I think they carry a lot of debt. I might be able to excuse them because we're going to look at the balance sheet on their on their balance sheet that is provided on their investor relations website, because I want to look at the inventory of cars, because they do have cars that they can liquidate. Like if they had to, they can sell off these cars wholesale, probably take a loss on them, but generate cash. So we're going to do that before I cast complete judgment on that balance sheet. So this coming year that is going to start March 1st, 2026, Yep, that's right. March 1st, 2026. They're expected to grow a tiny bit. Their earnings per share is also going to grow by 2%. So it looks better. And the forward P is looking okay at 17.6. But a business that has low margins, that isn't growing a whole lot, I'm like, I don't want to pay more than 10, a PE of 10. So it's still, I agree with the analysts. I think it's a little expensive. Okay, so we got that sorted out. Now let's take a look at their investor page and see if I can get my hands on their actual income statement they release. All right, so let's take a look at the investor page here. So that was the earnings call. So they just announced earnings here in December. That's good. Let's take a look at the SEC filings. And here's the report that I want to look at. All right, let's take a look. So I'm looking to see if their assets on the balance sheet are going to be able to match up to the debt level. Okay, so we already know about their income statement. All right, here we go. All right, so we already went over cash. We're good there. And then here, so here, total current assets. And here are auto loans held for investment, net of allowances for people not paying them. All right, so that's 16. Oops, sorry about that. So that's $16.1 billion. Okay, that's a big one. Okay, and then so you have that. Then you have property and equipment. Okay, that doesn't count because you can't sell your property and equipment all that easy. So auto loans. So where do they? So here's their inventory right here. This is the inventory of cars they carry. So these are going to offset that debt I was looking at. They had like $18 billion of debt, but you could see that this number plus this number, we get above 19 billion. Very good. So the balance sheet's okay because they could quickly, first the people that have borrowed money and are going to be paying CarMax are going to pay them. Okay. So this is going to get paid. Maybe there's a couple bad loans here or there, but for the most part, they're going to receive that money back. And if push came to shove, they can liquidate this inventory. So I'm okay with the balance sheet. Okay. So balance sheet's okay. The metric isn't really telling us the complete picture, not showing us the complete picture. All right. So now let's value the company. And it might be a little tough, but they do have some free cash flow. So let's take a look. We'll go to the valuation model that I use. This is my proprietary model. I created this because there was no real good tool that uses the principles of investing long term, that uses the value of a business based on the future free cash flows, as well as the value of the business based on the profits of that business. There was no such tool available out there. I'm primarily an investor. Okay. I'm not trying to recreate the wheel here, but I thought that there was a need there. So I created it for myself. And now I pretty much use it as the core valuation tool that I use for my investments. And I also share this model with people that are members of my channel. It's available to all members, whether excuse me, it's available to advanced, super, and platinum investors that subscribe under that level. And they get a nice terminal. They can go in and do their own valuations if they like. All right, today is the 19th, all day long. All right. And we're going to change the stock symbol. I'm going to refer to a screen that you guys can't see just so that I could do my data entry that much quicker. And we'll go ahead and do this valuation. Then we'll compare it over to CarMax. So CMX is the ticker. So the risk, I don't think it's that risky anymore. I think both these guys, I don't know about CarMax. CarMax was like headed toward bankruptcy. So I'm gonna reserve my comments on CarMax, or I'm gonna separate those from CarMax. Okay, let's take a peek at free cash flow. What kind of free cash flow are they producing over the trailing 12 months? They are supposed to grow nicely going forward, so that's a good sign. So their free cash flow is a $1,950,000,000. And they're not going to grow very quickly. I'm just going to go just 4% on the growth over the next couple of years, and then long-term growth. Just keeping up with them, staying right ahead of inflation. So you see that the cash flow, if they can pull off this growth trend, they should do quite well because their valuation is now looking pretty darn good. Now, this is the part of the model where I put in cash and take away debt. So this is what I'm going to do. You remember this here, right? I'm going to take 80% of this number and add it to cash. And I'm going to take 90% of this number and add it to cash. Let me try to clean this up a little bit. I think if I was in school, my math teacher would be like, clean up your work. It's not looking good. All right, so we're going to take this number, that one's times 80%, and then this one times 90%. We'll put that in the cash bucket because I got to be fair on the valuation, right? I can't, take away debt if not, I'm not representing the other asset items. So we had $204 million of cash. We're good with that. And now we're going to take that car inventory, which is $3,127,000,000. We're going to multiply that times 0.8. So we're just going to take 80% of that number. Then we're going to add those loans that are supposed to be paid to them. And it'd be very unusual if they didn't collect at least 90%. So we're going to go 16,151,000,000 times 0.9. And I didn't hit the old shift key on that one. So no problem. Got that squared away. So now we got what is, I'm going to say cash and inventory and auto loans, just so I remember what I did here. Plus advanced members, super investors, and platinum investors, they're going to see this real time. It updates on their terminals. So I want to make sure if they review CarMax, they're seeing my notes here. Okay, so we got that squared away. Let's put in that debt. Now that we've got kind of a fair evaluation of that, their total debt was $18 billion. All right. And then let me make sure my shares outstanding, they are not correct. So let me go get my My lookup that I use with Google lookups, we'll pop it into CarMax so that it could look it up for me automatically. So it looks really discounted. So sometimes stocks look really good when I get going, but sometimes once you go to the fundamentals, you're like, man, this is a terrible investment idea, but it looked good at the beginning. This one's the opposite. It was beginning to look terrible at the beginning, and now it's like, whoa, hold on a second. If they could do this kind of cash flow, and I'm going to restudy this cash flow, but let's finish this off, and then I'll go back and see if I want to adjust any numbers. All right, so the forecast. Let's take a look at the forecast. And I'm going to use the next full year because we're almost near the end of what they call their fiscal year 2026. It's going to end at the end of February. So the next full year, it's $2.77. Don't like this business. The best I can do is a 12, considering they're going to be growing. Now, they're going to grow nicely in 2028, but this coming year, not so much. So I'm going to go with an 8% growth there. And they got to walk before they can run, right? So they got to pull off just getting their business to grow in 2027 and then really grow nicely in 2028, especially their profitability. So overall, this is an opportunity. Let's take a look at their free cash flow and see how they've cash flowed in the past. And this is what I'm going to do. I like doing this, right? So what's great about having a subscription to Stock Analysis, as I do, I can go back to, long history. Well before COVID, kind of like what is the kind of natural levels of growth. They were growing really nice before COVID, and free cash flow. Let's look for that cash flow line. So they weren't cash flowing back then. So they didn't prove, they're not proving that they're a big cash flow company. Now they did cash flow in 23. Let's go more recent. So this looks good, but this is the best cash flow year they've ever had. Having said that, I shouldn't use it because I'm being overly positive, overly optimistic. They haven't consistently created cash flow, but they've had cash flow on a couple of occasions. So that could either average out kind of like the last couple of years, or I can tone this number down. Now they're supposed to start growing, so it could stay positive. Let's move that number down by, say, 50%. That way we're not overly optimistic because this is their best cash flow number ever. Maybe they stopped buying so many cars because their business didn't need them, and they will be generating that kind of cash. But let's just play it safe. So that brings down their cash flow quite a bit, but it's still, the equity value is 24 billion. So if they can cash flow, this thing is a winner. Okay. Now, what's the economy look like for used cars? Now, the consumer is doing fine. Now, the good news is that cars just keep getting better. The quality level has really gone up. So that's good. Now, let's take a look at Carvana. Carvana is on the other side. It's just priced too high. And look at this cash flow line. It's very similar. Even after I brought down the cash flow, it's similar. So, but Carvana's, really increased. It really rewarded investors that took the risk because they were really in a lot of trouble a couple of years ago. And I don't know if it's up like 17,000% or something because people thought it was going to go bankrupt. So CarMax, I think, is a discounted stock. Now, when is the CarMax stock going to begin to go up? That's the big question. So let me take a look at something real quick. Let me get rid of this guy. So over the 5-year, this has just been on a downward trend. It was doing great here. I mean, from 2009 up to 2021, this thing was a rock star. And now it's really sold off. It is showing a small bump, right? I guess, and looky here, right? They announced their earnings in late December. What was the date? They announced December 18th, which is roughly around here. It's actually back here. And since then, investors are looking at the numbers saying, there's some value here. There's some value in CarMax because it's almost kind of being left for dead. And if they can pull off this growth in their business and keep driving that cash flow, improve their business to that profitability that they've had in the past, this is looking really good. It's a good one, Cody. So CarMax is looking good. Let me check in on the chat here. What do you think, Cody? Any disagreement, alternative kind of perspectives on CarMax? This was a good one. It shows that, I love finding stocks that are beaten down, left for dead, and you buy them at the right time and then they really recover. This may be one of those stocks. And the market's already taken this stock up 27% over the 1 month. And over the last 5 years, it's taken it down like 68.4%, even after that rise. So there's a lot of meat left on the bone on this one. So it's looking pretty good. So good one. Glad you brought it up. And hopefully you enjoyed the analysis. And I don't remember, Cody, but if you're an advanced member, you're going to see this research on the valuation tab. And this will be visible to all investors that are advanced members. Could you get access to this, all the valuations? Let me add it over to the, add it on the watch list. It's not listed there. What's their industry? Consumer discretionary. Sounds good. So this one here, I'm going to say this deserves to be in the watch, potentially buy category. Let's pop it in here. All right, we got that squared away. Let me just update this guy because, as mentioned, as I update the valuations, there's over 350 valuations. It updates what investors that are paid members at advanced and super level, it updates their terminal, and I don't want it to be incomplete. All right, so that is not correct. Let me go ahead and correct that. All right, now I can move on. And if an investor, let me show you what I'm talking about. So if an investor, let's say, wanted to look at CarMax, right? Let me hit refresh here. CarMax didn't exist in the valuations, but if you hit Control F We look for KMX. There it is. Here's the work we just did. And it's available to advanced, and it's available to super investors as well. So super investors, advanced investors get to see this research real time, 24/7. And you see, as we update these valuations, I got to hit refresh to see the new data. Then they get to see it on the terminal. I just hit refresh and boom, here's CarMax. So I don't remember, Cody, if you're what level you are, but there it is. It's available to you. If you don't have the right level and you want a copy of that, just let me know. I'll shoot you a copy over email or something. Thanks for asking about that. Good to see you on the stream. Looks like Shadow Guy is having a happy Monday. That's good. It is a nice Monday. I'm in Southern California. I think for the time being, Shadow Guy's in Northern California. And it's nice and sunny down here. So I'll take it. Ricardo, good to see you. Good to see you on the stream. Yeah, let's take a look. So the 1 year performance of VXUS. So which one should I click on here? I think it's this one. We're going to compare it. BTI. Yeah, international stocks did outperform U.S. stocks. Yep. So not a big secret. I did a video covering China stocks, and it really looks like other regions of the world are going to go up quite well. And I think part of it is the U.S. has been just on such an increase in valuations. That's great. I've got a lot of U.S. stocks. Have nothing against it. I hope it continues. It's just a fact. When you have higher valuations, the chance of it continuing to go higher is going to be tough. If you look at other regions like China and Europe for a while is cranking, you see that they have a lower starting point, so they can go much higher, they can appreciate much quicker. So that's looking good. Thanks for bringing that up, Shadow Guy. Ricardo, you want to look at IBM, Big Blue on the list, sir. I'm going to look at Barrick Mining, which was a request from Matt. He emailed me, I think either this morning or yesterday. I forgot when. But we're going to go over that one next. Then we're going to go over IBM. Take a look at the earnings after that. Which ones are coming? Mohammed, very good to see you. Cody. Yeah, so I'm really glad you brought that up, because that is one of the recipes of success for me, is looking at businesses that I can get my head around and buying them at the right time. And most definitely, CarMax is looking like there's a lot of value. There's a lot of meat on that bone. And if the market begins to recognize it and it starts to rally, you got something. So thanks for asking. It is sunny, looks like, in Northern California. That sounds good. So, what's going to happen in Northern California in approximately 3 weeks? The Super Bowl is going to be played at Levi Stadium. It's actually Santa Clara, California, but that's where the San Francisco 49ers play. All right. Let's keep moving. Gold is on its way up. So let's take a look at Barrick Mining. And Barrick Mining's just been killing it. If you look at the 1 year, 207%. 5 year, because 110% because it kind of settled down. That graph doesn't look right. Yeah, I guess it does look right. But the 1 year, phenomenal. And that's because gold prices are going up. The market cap for Barrick is 82.2 billion. Forward P ratio of 13, just 13. That looks pretty good. Analysts think it's gotten a little too expensive. Over the 1 month, it's up. 1 day, it kind of sold off, but I think it should be rallying higher in the after hours because gold prices are moving higher. So top line revenue has been growing well for Barrick. 18.39%. And I'm going to guess that the increase in the commodity price is really most of what's going on here. Is now that the per ounce of gold price went up so much, these guys get to make more money by selling that gold. So we got revenue, cost of revenue is only 7 billion. So pretty good profit left over. Let's take a look at the profit and free cash flow. So good top line growth. Look at that cash flow. It's just coming in. Nice. Gross margins really picked up, and it's all about the price of gold. As it goes up, Barrick gets to make more money. In fact, look at their margins. Their net margin, they lost money back in 2018. It was pretty tight in 2022, but now they are just flush with profits and cash. So that looks good. Now, what's going to happen to the price of gold? I don't know, but I don't think there are reasons out there why I would expect that it's going to go down anytime soon. You never know, but they could have another great year followed by another great year. So that looks really good. Top line growth, profits there. I'm pretty sure their debt's going to be fine. Yeah, they have more cash than debt. That's a sign of a strong balance sheet. And I'm willing to bet also that they probably carry some gold inventory that they haven't sold yet. That should be included in that cash. So we're good there. So what are analysts thinking? Analysts think it's a little too high priced. But when we look at, this is the year we're in. They're growing by 24% in 2025. I should restate that. This is the year that just completed, and they'll be announcing that year over the next couple months. And the year that we are actually operating in is 2026. And they're supposed to grow nicely this year. And the next year, keep growing and then grow a tiny bit in 2028. The profits are going to expand nicely this year. There's a lot to like here. There really is a lot to like here. PE ratio is really dropping. So that looks good. So Barrick Mining. Now, I have Barrick Mining as a stock that I think we evaluated. Let me take a look. It looks like I don't have a valuation on it yet. So we could definitely work on Barrick Mining because it's a really interesting stock. All right. So Barrick Mining, I'm going to put them near Ternium, which is one of the, see, there's Southern Copper. There's BHP. All right. So we'll pop them. Let's put them right here under BHP. All right, let's do a full valuation of Barrick, see what they're worth. See if it's still priced well and presenting investors with a good discount based on free cash flows in the future, based on the profits they're going to produce. All right. The risk level of mining, I think it's higher than your typical business. A lot of things can happen. You can have an accident at a mine. You can have a lot of things go bad. You can have the commodity price collapse. Therefore, it's going to have a higher risk level. Like if you looked at Google or Facebook, it'd be at 7.5. This one will be at 8.5. Now I'm going to refer to another screen you can't see in order for me to get the information I'm looking for. That way I can pop it into the screen. And let me take a look at the free cash flow to begin with. And I'm looking at the free cash flow, and similar to what we did on CarMax, looking at the cash flow and seeing if that's something that they've been sustaining. What I like seeing is that this is not their all-time cash flow. It's been kind of ramping up, which is a good sign. I like information or data that is trending because that trend is, it builds confidence in my mind. So this is 2,750,000,000. And so next 4 years grow by 6%. Yeah, that's fine. And then 4% after that, that'd be fine. Now, probably going to be a little light there. So this is what I'm going to do. I am going to have three growth rates altogether. The growth between years 1 and 2. I'm going to grow that. And what was the forecast stating for Barrick? Look at the forecast. In 26, we're going to grow by 26%, and profitability is going to grow by 47. In 2027, they were going to grow by 7.5, and they grow by 13. So I'm going to grow this by 14%. And then going forward from there, it's not going to grow a whole lot. So let's go with 4% there. Actually, we'll go 5. All right. So we got that there. Now let's add cash and take away debt. Let's take a look at those balances and we can update it. So balance sheet, 5,040,000,000, and then the debt level, 4,710,000,000. Shares outstanding, that is not current, no problem. Okay, so we got our shares outstanding in there. So based on cash flow, this one is priced a little too high. Now let's take a look at earnings per share. What is it expected for the next full year, 2026? $3.36. This is a quite popular industry right now. So I'm going to go with an 18 PE, and it's supposed to grow a little bit from there. So Barrick Mining is priced 4% too high. What were analysts saying on this one? They're saying it's priced 9.7% too high. So I'm going to stay away from Barrick Mining. There's just the upside on it. The increase in its stock price has been tremendous. But maybe there's not a lot of meat left on the bone. Investors have already taken the stock much higher. Now think about the risk. What if gold starts to come down? Well, Barrick Mining stock is really going to sell off. So I wouldn't want to be caught up in that mess. So I'm going to hold off. I would say Barrick Mining is, if you already owned shares, I could see an investor holding it. But other than that, I would not be an investor. There's just not enough there for me to invest. I want to make money. I don't want to own a stock just to own it. I want to buy something that's going to go up in price. So Barrick Mining, really good last couple of years, and maybe it keeps going. But for now, I'm going to stay out of it. There's just not enough there left for me. Let me update the watch list because, it updates to all investors, and I don't want them to be surprised not have the information on Barrick, especially since the person that asked about Barrick, he has access to the research. So I want him to have all the details available 24/7. All right. So I'm going to update the intrinsic value on Barrick, which is right here. And this one here is just a watch stock. Not enough left there for me to invest, but an interesting stock to look at because gold's just been flourishing, right? Geez, just been cranking. All right, we handled Barrick Mining. That goes out to Matt. Thanks for asking about that one, Matt. Hopefully you find the analysis interesting and useful. Thanks a lot for being a member. All right, let me check in on the chat. Then we're going to move to IBM. Let's take a look here. Oh, so Shadow Guy is actually going to support the Hawks, the Seahawks. Man, they might run you out of town if you're in San Francisco, Shadow Guy. Be careful who you tell that to. There's a lot of hatred there between Seattle and San Francisco, but man, Seattle really handled the Niners. Am I still rosy on TX? The answer is yes. Ternium is doing well. And, I like a couple of things about Ternium. One of them is their location. Their location geographically is ideal. They're just south of the border of the U.S. They supply a lot of the materials, both to the supply chain down in Mexico that feeds the supply chain in North America, U.S., and Canada. They also have other plants and operations in Argentina, Chile, maybe not Chile, Colombia, I think. And those supply China. And China is booming. And China's building a lot of plants in Latin America for cars, appliances, all kinds of stuff. So I still like Ternium. It's my single materials holding. So yeah, I'm still positive on them. I still think they're discounted. So we're good there. Thanks for asking, Shadow Guy. Good to see you. All right. So Ricardo wanted to look at Big Blue International Business Machines. And these guys were having a terrific year. Look at that. You could have picked up IBM for a real low price just in August and wrote up a nice gain on this stock. But over the last couple months or so, not so good. What's going to happen to IBM? Now that we've got all this AI stuff going around, are they going to keep up? Well, let's take a look, see what their revenue is all about. So International Business Machines is actually a company that has a very long history. Believe it or not, these guys started manufacturing typewriters. Because think about 100 years ago, we didn't have, computers, personal computers. We didn't have a whole lot of electric machines or appliances and stuff like that. A lot of mechanical stuff. So these guys made typewriters, and they did go electric very quickly. So if you were to walk into an office in the 50s, there'd be a bullpen of typewriters. And IBM was part of that. And then they were, I would say, timely in creating computers, which they created mainframe computers, very high performing computers after that. Of course, the PC revolution, they were part of that. But more recently, they have not been a big player. I think the world's kind of moved ahead of IBM. IBM's kind of caught up in, the technology that we were crazy about in the 90s. And now it's all about AI and all kinds of, iPhone and stuff like that. These guys just aren't the player they used to be. See, they were founded in 1911, so they're over 100 years old, and they're a technology company. Isn't that incredible? Just for them being able to say we're a technology company, we've been around for 100 years, makes them very unique. They are a big cap, $285 billion of market cap, revenue $65 billion. Forward P at 25.29. They pay a dividend of 2.2%. Now, the revenue is not red hot. 4.5% revenue growth doesn't really impress me because, I could buy Amazon and I get better growth. I can buy Alphabet, better growth, Meta, way better growth. So I could buy a lot of stocks that have better top line revenue growth. And that's part of what I see with IBM is they do just enough to keep themselves as a viable company, but nowhere are they, for me, they are not near the front of the pack when it comes to technology. So these guys here, they cash flow really well, 12.4%. Good job. It's an established business. It's a slow grower. On their gross margins, those are good gross margins, 57.8. Profit margins at 12%. It looks pretty good. So those numbers look good. What are analysts thinking? All right, so 13 analysts cover it. They think it's fairly priced. 2026 numbers, they're going to grow a little bit, 4.68, and then 4% in 27, 5% in 28. The earnings per share is going to expand nicely. That looks good. And their P ratio is going to stay in the mid-20s. Now, for mid-20s, I can buy some pretty good stocks, mid-20 PE. And IBM is not one of those stocks that I'm like feeling like, hey, I'm buying one of the leaders. I do feel about, Alphabet being one of the leaders, Amazon, but not IBM. I think, as mentioned, they've been around for over 100 years. But in technology, that's not an asset. That's not like a characteristic that means anything. It just means you've been around for 100 years. It's all about, what does your technology do? Are customers excited about it? Okay, so we went over the fundamentals, and I don't know that I have a valuation on IBM, but we can fix that. That'd be easy to fix. We can just create a valuation. No big deal. All right, let's create a valuation for IBM. I'm surprised I don't have IBM in there. No big deal. So IBM, what are they like? I'm going to put them next to Google. All right, so let's copy this as a starting point. And Google's growing by like 16%. So my comments that I was making on IBM, that IBM's not as big as Google. Google's like 5 times bigger, maybe 7 times bigger, and they're growing much faster at a faster percentage growth rate. So IBM is not a growing company. It's not like they're leading in any category of technology. They're just kind of, in a way, hanging on. I don't mean to be kind of a negative person toward them, but I'm kind of trying to state my observation as clearly as I can, as I see it. Now, I'm going to take a look at the fundamentals that we just went over on a different screen you guys can't see, so I could do my data entry. and we'll get this valuation on IBM squared away for Ricardo. And I was mentioning that the weather's nice here where I live. I think it's also nice where Ricardo lives. All right, so free cash flow. These guys do produce nice free cash flow. And a lot of mature businesses produce good cash flow, but the market really rewards growth. Growth, this is the number that really expands, valuations. If you're growing by 30%, man, it expands your valuation quite nicely. All right, let's take a look at the balance sheet items. Oh, man, the debt on the balance sheet is not looking good. We're going to have to take a closer look just to make sure I'm being fair to Big Blue. All right, let's look at the balance sheet together here. Because what if they have, like we saw with CarMax, what if we saw that they are carrying a lot of paper for customers that are buying their technology? So let's just make sure. So what do we got here? Let's see here. SEC filings. They just took me out here. All right, so I think this is going to be the one that we want. So here's the balance sheet, the most recent one on International Business Machines. We got cash there. Okay, marketable securities. We got that accounted for. So they do have some long-term financing receivables, but not a ton, just 6.2 billion. Okay. And liabilities, so short-term debt. Long-term debt, 55. All right, so I'll give them credit for that amount that they had in receivables from financing that they have with customers. But I'm going to write that down by 80%. No, 90%, excuse me. So 6,258,000,000. Okay, and now the debt was this. All right, so our equity values not getting it done, not there. And what's going on here? So, and I got to update my share count. So based on cash flow, IBM, and I'm using a higher discount rate there because higher debt level, and I think that IBM is falling behind the curve. And one thing I didn't show is their debt to EBITDA is 4. So this debt balance is a little high. So that, see how on Google Alphabet, they have a super good balance sheet, way more cash than debt, 7. But on IBM, 8. One is the balance sheet isn't as good, and the business isn't as good. I don't think people are going to argue with me that the next 5 years should be very good for Google Alphabet. But with IBM, it'd be like, maybe they're not good. And if they suffer, that's the risk that we would be needing to take to be an investor in IBM. So I'm playing it safe on IBM. I'm going to use a higher discount rate, which would give us a lower valuation. Now, taking a look at the earnings per share for IBM for the 2026 year will be $12.32. I am not going to give a mid 20s PE ratio for IBM. They're a slow grower and they do not belong in the 20s. They're also, their margins are south of lower than 60%. There's some businesses out there that have better margins. The growth isn't all that great, and they're supposed to grow by about 6% going forward. So IBM is priced 12% too high. It is not, it's a sell for me. And a couple of reasons. And I know that we have younger investors on the stream. This is not the right, like my 25-year-old son, I have a 21-year-old son. They said, hey, I'm thinking of buying IBM. You know, it's their decision, but I would encourage them to think about a business that's going to be great for the next 20 years and really has a technology and a culture where they're just going to keep getting more important. IBM's kind of past its prime. I think IBM's no longer relevant, and I would discourage my sons from investing in a stock like this if they're young. Older investors who want that dividend, I would say that you got to wait for this thing to be discounted. I did look at IBM when they were about 30% discounted. And I thought, interesting. I didn't buy, but it looked good at that point. I would wait for something like that when it's discounted by 30, 40%. Then the buying would be good. You buy under conditions that are good for you as an investor. But IBM's just not going to make it to my portfolio. I just know too much to be comfortable with a stock like that. I'd rather invest in companies that are going to own the future. So I'm going to add this guy to the watch list. Sorry that I'm kind of wearing out that comment, but I just want to make sure that this thing is nice and complete. I can tidy up my valuations that way. When the advanced, super, and platinum investors are looking at these, it is a complete body of work. So we've got IBM in there. So that's for you, Ricardo. Hopefully you found that interesting. Thanks for asking about IBM. All right. So all right. So I think we're back to the Niners, Seahawks. That's playing it smart. Yeah, man. I bet the weather's always great, Ricardo. Cool. All right. We're all caught up on valuations. Good stuff. We covered IBM. We covered CarMax. CarMax is really interesting to see how on the surface that doesn't look all that great. But once you look at the numbers tell us a different story, a good story. Hopefully a story with a real positive ending that the stock's going to go higher. Be great to watch that one there. We looked at Barrick Mining's been flourishing. IBM's been doing well. So that looks good. Okay, so as mentioned, we've got some earnings coming up. It's a pretty busy week. We've got tomorrow, we're going to have Netflix announcing after the market closes, but before the market opens. And we have a paid member call tomorrow morning. So we could probably talk about 3M in the morning call. U.S. Bancorp is going to announce before the market opens. Fastenal. This is an industrial stock. Interesting company. They do fasteners. D.R. Horton, a home builder. United Airlines, after the market closes. And I'm keen in on that because I want to understand how travel is doing. I'm expecting that they're going to announce good earnings, that, hey, the consumer is traveling. They continue to buy airline tickets and take trips. Interactive brokers, that's been a good stock. Like Robinhood, like Charles Schwab, that's been doing really well. Some good stuff coming up tomorrow. Very interesting. Some regional banks. Regional banks are supposed to do really well, and they're priced well. Zions Bancorp. Moving to Wednesday, Johnson & Johnson, some big healthcare. Charles Schwab. These are before the market opens. So on Wednesday, I plan to stream with Daryl. So we'll have plenty to talk about in the morning stream on Wednesday. Prologis, I believe they are a real estate investment trust that handles warehousing. So businesses that want to run warehouses and lease them out from Prologis, that's what they do. We've got TE Connectivity. I'm not familiar with that guy. This is a financial services company. Kinder Morgan, I believe, is in oil and gas. The Travelers Insurance Company. Halliburton, this is an oil and gas services company. I am familiar with those guys. And then Alley Financial, they do car loans and stuff like that. So busy week. And then Thursday, GE Aerospace, Procter & Gamble, Intel, Abbott, Intuitive Surgical. So some pretty significant healthcare companies are going to announce on Thursday. Freeport McMoran, I believe they do gold. We talked about Barrick. I think these guys are a gold miner as well. Capital One, the big credit card company, and these guys have been getting their stock price reduced because there's been a lot of speak in government that they want to cap the amount that these companies can charge on credit cards, like the amount of interest, which could severely affect Capital One. So interesting, some regional banks, CSX, this is the railroad. So see how they announce. Not overly exciting. So it's going to get busy. It's going to get busy starting tomorrow, and it's going to stay busy. And it's going to stay busy for like a month. We'll have plenty of new stocks to talk about, earnings. There'll be some surprises to the upside, some surprises to the downside. So what are the expectations and picks for healthcare this year? So I'll kind of divide that question into different types of healthcare. Let's see if this is going to help me here. Yeah, to some extent, this is where healthcare is at. And I'm going to go to the 1 year. Now, the pharmaceutical companies in this particular box, Lilly's been doing great. Look at J&J. Look out. Get out of the way. J&J is busting through. Looks really good. Med devices, health plans. And these are Intuitive medical instruments. So there's different industries within healthcare. And I would say this, that if you want to buy growth, buying growth in healthcare right now, you get it at a really good price. So you can find companies that are growing 30, 40% per year. And in biotech, and the valuations are pretty reasonable. So that's one thing that I'm really picking up on as a big opportunity. I think there's some rebound stocks like United Healthcare. I think that's going to work. I think there's some good opportunity in healthcare in 2026. And it isn't overly bid up. It's like, if you look at the 3 year, I don't know if this is going to show us a good picture. Some of these stocks have not participated in this boom. It's hard to go higher when you've got these stock prices that are so darn high. Okay. But if you've kind of been a laggard over the last 3 years, but your business continued to grow, your business continued to generate profits, there may be some opportunity there. So you can pick a different type of investment within healthcare. If you want growth, you can find it. If you want value, like something that's going to pay a really good dividend, be a slow grower, real stable company, Healthcare has that for you too. So I think healthcare is going to have a good year. All right. So I'll leave it at 1 month. What's the 1 month look like? Over the 1 month, looks like Google's had a good month. Nvidia, Broadcom, Micron, 52%. Look out. And TSMC announced last week, and boy, the whole semiconductor equipment industry flourished. Looks great. All right, so we got the request handled. Now I had a couple questions, or I should say, was some topics that I wanted to cover. First one is Comcast. So I think it's a good idea that Comcast has decided to really focus their business on what they think is more desirable going forward. They had some assets that were linear TV assets. These were like, really great for the last 30 years or so. But really, once we got into streaming and now everybody's on TikTok and YouTube, not so much. Those assets are not very good. So they spun off a company that's going to take away CNBC, MSNBC, and a bunch of these cable channels that were really born in the cable era. It's a good idea. Focus the business. Now they're going to announce on the 29th. So we're not quite 2 weeks, less than 2 weeks, 10 days away. I'm going to really study that earnings because this stock's been beaten down. I mean, look at that beat down. Jeez. From 60 a share down to 27. And this stock has been growing. But I think part of its, challenge is it's been growing in spite of the linear TV businesses, which have been contracting, just getting destroyed by YouTube and all the different streaming platforms. So if they can shed those liabilities and enable themselves just to focus on the businesses that are worth having, it's going to improve the company quite a bit. I think it's a really good idea. So I'm really looking at it as a potential investment. I like the high dividend, but are they going to change the dividend? That's why I want to listen to the earnings call. The market cap is pretty good size, but it's not the biggest in its space. These guys remind me a lot of Disney. They're smaller than Disney, and I like their assets better than Disney, by the way. I think Disney depends too much on the studio, too much on the theme parks, where Comcast doesn't. They have a big broadband business. Comcast does. And that's always going to be in demand. So this is going to be an interesting stock to follow. I'm going to be watching this earnings, see if it's an investment I want to make in 2026. It's going to be a good one. All right, let me close some of these tabs here. So Comcast is coming. We'll see what it looks like. All right, so we talked about gold earlier. The other company that, has just been flourishing is Southern Copper, and it had a down day. It's rare, but it had a down day. If you look at the 1 month up, 1 year really up, 5 year up a lot. And man, I missed this one. I reviewed this one on a video and thought, this is a good investment. And I just didn't pull the trigger. And, welcome to stock investing. It's a lesson that, hey, if I see something that makes sense, I do my research, put a few dollars down. That way you can participate in this kind of rise. But for now, I think I'm just going to hold tight. It's just, it's run up too much, too fast. And if we have any kind of pause on the price of copper, we're going to see this one really settle down quickly, maybe from 180 down to 120 fast. I don't want to be part of that. I'd rather wait for it to sell off. So I'm going to I'm going to hold off on Southern Copper. I like to revisit these stocks and see at what point do I want to pull the trigger. And that one there, it's just looking like it was too rich of a valuation. So I'm going to change my plan on Southern Copper and change it to just watch, potentially buy. All right, so that was Southern Copper. All right, so as mentioned, I've created these terminals for super investors as well as advanced investors. And the terminals are really so that based on the research, I've completed well over 350 valuations of companies, and I continue to update them on live streams, on videos, when I create videos. So you get access to all this research if you're, in this case, a super investor member. You also get access to my portfolio, to the charts that dissect my portfolio based on what each position is worth or percentage of that position um, in my portfolio, as well as the sectors I'm invested in, all the active buys and sells that I'm performing. You get access to that. And then my watch list that you guys are seeing just a minute ago. So investors get to see that 24/7. And advanced investors, you get to see all the same valuations. You get more of a stock list. And this one here is just listing out all the stocks that we've covered. And we've got over 350 evaluations and research done on companies. So if you're not a member yet, consider being a member. And if you're an advanced member or a super investor member, you get access to those terminals. All right. So it looks like this, we're going to open lower. If things stay the way that they are, and it looks like it's improved a little bit. When I started streaming, the S&P futures was down more than 1%, and the NASDAQ was down 1.5. So for all I know, by the time we open tomorrow, it's going to be even better, not as bad. So we'll see. I think the threat of those tariffs is moving stocks lower. So that just is what it is. All right. So I think that's going to be the stream for the weekend. Glad that I had a chance to stream with you guys. And I was able to catch up on a few requests that were made. Thanks for your patience on that. And appreciate you supporting the channel and you get me those requests. And I also appreciate the requests that came in during the stream. Appreciate you making it interesting. So that is it for today's stream. I will be streaming again probably tomorrow evening. Not sure if you're an evening person, but tomorrow evening I'll probably stream. And then I'm going to stream Wednesday morning. I plan to stream with Daryl. And we'll go over some of the earnings that come out tomorrow. And they'll also come out on Wednesday. There'll be plenty to talk about. Be really interesting. And you're welcome, Shadow Guy. Good to see you. All right, guys. So enjoy, in the case of people here in the U.S., I think your day off. Today is Martin Luther King Day, and it's a recognized holiday. Enjoy your day off. We'll have a shortened week, 4 days of trading. And we're really down to the last 2 weeks of the month to see where portfolios are going to go for the first full month. And one thing I haven't checked in on is, and I'll do it on the next stream, is the contest that we have going. We have, let me try to open that up. Let's see here. Let me get it ready for prime time. If you recall, we had a contest where So this is sponsored by Stock Analysis, and the winner of the first quarter gain, which is represented here. Yep, that's correct. Will get a free subscription to Stock Analysis. Let's hit the old sort button here. We're going to go from biggest to smallest. It looks like Trev Byrne, that picked Iren, is leading the pack. 54% rate of appreciation just in 2 weeks. Man, that's good looking return, huh? SG Dad with Hive, Juicy with Nebius, Little J with BitF, Carl BTBT. Man, these are like super picks here. Got Jan with Oust, very good. Oscar's up 15%. Looks good. Looks real good. And now I'm not doing all that great. I think I picked Occidental. Let's just kind of, I'm not going to flip it. We'll just go with the winners here. So we'll see if Trev Byrne is going to hang on to his lead. There's a lot between now and the end of the month. We have a lot of earnings coming, and we'll see who's going to be leading at the end of the quarter. It's not the end of the month that claims the prize. It's at the end of March. So at the end of March, we're going to see who leads, and then they get a free subscription to Stock Analysis. Big thanks to Stock Analysis for sponsoring that particular contest. And I think we're going to have prizes at the end of each quarter. And the best prize will be at the end of the year. You know, like whoever guessed and at the end of the year, it'll be for the full year. It'll be like, okay, on December 31st, 2026, who's leading there? Okay, they get hopefully a couple of things, whatever I could afford, whatever Stock Analysis is willing to contribute. And for all I know, I'll get a sponsor between now and then that can throw in something to sweeten the pot. So it's cool that so many people put in their best guess. Looks like we've got some stocks that are off to the races and making the contest exciting. So we'll keep tabs on it. And I'll do a video at the end of January just to highlight the stocks maybe that are leading the pack. I could kind of take a look at their fundamentals and see why they're doing so darn good. All right, guys. So with that, I will say goodbye for now and look forward to seeing you on the next live stream. Thanks so much for tuning in.